Building a diversified investment portfolio is one of the smartest steps you can take to secure your financial future. It's not just about picking random stocks or funds, it's about strategic allocation to protect your investments and maximize growth over time. In the next few minutes, you'll learn exactly how to structure a portfolio that balances risk and reward for long-term success. Diversification starts with understanding the key asset classes: stocks, bonds, and alternative investments. Stocks provide growth potential but carry higher risk. Bonds are more stable, acting as a safety net during market downturns. Alternatives like real estate, commodities, or ETFs add additional layers of security and variety. Begin by determining your risk tolerance and financial goals. For those with a higher tolerance for risk and a longer time horizon, allocate a larger portion to stocks. If stability is your priority, increase your bond allocation. A common rule of thumb is the 60-40 portfolio: 60% stocks and 40% bonds, but this is just a starting point. Adjust it based on your age, income, and goals. Within each asset class, diversify further. For stocks, include domestic and international companies, large cap, mid cap, and small cap stocks. In bonds, consider both government and corporate bonds with varying maturities. ETFs and index funds are excellent tools for achieving this because they inherently spread investments across many securities. Consider alternative investments. Real estate offers steady income and growth potential, while commodities like gold can hedge against inflation. Diversified ETFs focused on alternative assets can simplify this process. Lastly, revisit and rebalance your portfolio regularly. Over time, the value of certain investments may grow or shrink, altering your allocation percentages. Rebalancing ensures your portfolio stays aligned with your original plan, maintaining the risk level you're comfortable with. Building a diversified investment portfolio doesn't have to be complicated, but it does require intention and discipline. Allocate your resources across asset classes, spread risk within those classes, and commit to periodic rebalancing. By following these steps, you'll create a portfolio designed to weather market fluctuations and grow steadily over time. Start small if you need to. The most important step is starting.